Nigeria's central bank maintained its monetary policy rate today at 12% for the 11th consecutive time, citing a success in containing inflation, and a currency that has suffered downward pressure from dollar demand has reasons to stay the course, but it introduced a surprise 50% cash reserve requirement on public sector deposits of banks to curb a practice of banks effectively taking government deposits and lending the money back to the government for profit by investing in treasury bills. But what does this move mean for banking stocks? Joining me on the line to discuss the Monetary Policy Committee's decision to fix the consumer reserve ratio at 50% on banking deposits is Soji Sholanke. He's a sub-Saharan Africa banking analyst at Renaissance Capital. Thank you so much, Soji, for joining us.
Yeah, hi.
Well, let's start with, of course, this is something that's going to affect banks across the board. But let's talk about how this is going to, the first impact we will see on banks, particularly on the cost of funds for banks and perhaps going forward on their earnings.
I think the first way to look at this is there's already a 12% cash reserve ratio in place on total deficits in the banking system. However, there's now this additional 50% cash reserve ratio on public sector deficit. I think overall public sector deficit is just about 17% of total system deficit. However, considering this is an additional charge on deficit, okay, I think it's net negative for the banking industry. So if you are to look at all the banks, we think the bank that is likely to be least affected is probably GCB. The most affected banks will be your tier 2 banks. So whether it's Sky, FCMB, Fidelity, Diamond, your tier 2 banks basically. The positive side for the tier 1 banks would be from the viewpoint that interbank asset yields are set to rise. So that's treasury bills or interbank lending. Okay, you should actually see those asset yields rise. So that's positive for the tier 1 banks. So on the funding cost side is negative. On the asset yield side is positive, but more for the tier 1 banks than the tier 2 banks.
Now, do you think this could spark an unhealthy competition for deposits among these banks? We know that these funds, public sector funds, are funds that many of these banks rely on. Going forward, what do you see the competition space looking like?
I think that's why I started. Hello?
I can hear you. Go ahead.
Yeah, so that's why the first thing I said was public sector deficit is just 17% of total system deficit, according to central bank data. So that itself is not that significant. I think what you have to look out for is how significant is it per any particular bank. So in other words, how diversified is any particular bank's funding base? Okay, so at a bank like First Bank, although it does have public sector deficits, what you tend to find out is banks like First Bank and Zenith Bank, they typically have a policy where the public sector deficits are to a large extent matched into treasury bills. Okay, so to that extent, probably they might be less affected. So from that viewpoint, your more affected banks would be the tier 2 banks, which are much smaller, okay, because public sector forms a much bigger proportion of their funding base than for the bigger tier 1 banks.
Okay, going forward, how do you see this? Is this going to be a drastic change to the banking space, or is this something the banks, perhaps in the short to medium term, will shake off, and then we might see things normalizing?
I think there are short-term risks. The key thing which Nigerian banks have always been able to do is they eventually find a way to go about these things. If you also consider that a good portion of AMCON bonds are maturing by end of this year, okay, I think from the viewpoint that we are not sure whether CBN would 100% mop up the entire funds from the banking system or probably leave some of it to still sit in the banking industry, that will probably ease the liquidity pressures the banks face in the short term. So I think the risk from this new policy are short term. It's probably going to be, there'll be pressure for a couple of months, okay, but let's look at what happens by Q4 of 2013.
Okay, now going forward, do you think that this could make investors at the Nigerian or at the stock market nervous, because we're being told that this could spark a sell-off perhaps in the short to medium term of banking stocks? What are your thoughts on that?
I think this basically adds to the headwinds for the banking sector this year, because there were already headwinds from fee and commission income. We also have headwinds from rising costs on the back of the higher AMCON levy. The only positive I can say from this angle is asset yields are set to rise for the second half of the year. For most of the first half of this year, And if you look at treasury bills or interbank rates, they're about 200 to 300 basis points lower than what we had first half of 2012. The outlook for the second half of this year is that they'll be much higher than what we had in the first half.
Right.
So I think that's probably where you have a positive story. So generally, what I do think is probably your bet should still be on the tier 1 banks.
Okay.
Because basically all these new policies are bottom line negative for a couple of the tier 2 banks. So the tier 1 banks are probably going to be on net winners, and the tier 2 banks will be on net losers.